let's talk about some job risks and fit. Now, we're going to tackle this from 4 different perspectives. We'll touch on legal risk, job fit, job availability and scarcity, and last but not least, personal risk. So let's start off by talking about legal risks to consider when you look at career paths in this industry. So clients can and do sue their advisors from time to time, and it's not meant to scare you, but it is a fact. Now, it's very rare to actually find a successful advisor with a multi-decade career who hasn't been faced with some sort of litigation related to their wealth management practice over their career. Now, because the investment policy statement and fiduciary responsibility are legally binding, obtaining a portfolio manager's license directly introduces an element of personal risk to the PM that wasn't present when they were just an investment advisor. So the decision to apply for a PM license has to be considered very carefully, and it shouldn't be done just for the title. Now, running a discretionary practice isn't just managing money without calling clients. It's much more than that. It's an entirely different way of running a business that we talked about, and advisors that are considering this route need to make sure that this option is right for them and for their clients and is consistent with the direction that they're taking their business. So this legal risk element is particularly relevant to someone pursuing a PM designation and role. Now, let's talk about a few things that you need to consider about job fit. Now, many of you are currently in the process of evaluating career options and considering which type of advisor role would work best for you. Now, while many traits and skill sets are common across successful advisors of all types that we've seen, there's a few key differences to be aware of as well. So generally speaking, becoming a financial planner is the lowest risk option for a number of reasons. So for starters, as we discussed, FPs are typically given a modest base salary from the firm that they work for. This means that there's no probationary period with a hard cutoff date, like the way that there is at many wealth management firms. And this means that financial planners don't really have to worry about generating enough revenue to, say, pay their mortgage. Now, the second reason that the FP route might be the lowest risk is that target client segment. So because FPs are focused on building books of average middle-class clients, there's really no shortage of prospects for FPs to pursue. This is a very common problem for advisors in the wealth management space, though, because IAs and PMs are typically looking for clients with at least $1 million of investable assets. And the number of those qualified prospects out there is, quite frankly, smaller. And this can make building a book, especially for junior advisors, very challenging and stressful. Now let's turn to the topic of job availability and scarcity. So this takes us to the topic of what job opportunities are actually available out there for you to pursue. While the financial planning and wealth management industry as a whole is growing very rapidly across the world, the reality is that there is a much larger need for financial planners than there are for wealth managers, just due to the prospective client base that we talked about. Now, what does this mean for you? It means that the hiring process for financial planners is a bit less competitive than at wealth management firms. And in practical terms, this means that a financial planning firm might be more willing to take a chance on a candidate who lacks a particular bit of experience. Whereas in contrast, wealth management firms typically don't have any issue finding fully qualified and maybe even slightly overqualified candidates. Last but not least, let's talk about a topic that we briefly touched on earlier, and that is the topic of personal risk. So wealth managers have an open product shelf, and they can recommend individual securities rather than just managed solutions. So there's naturally a higher probability that they can get it wrong. And advisors that recommend investments resulting in heavy client losses can be sued by their clients who may claim that they were led into taking on risks that were inappropriate for them or that they didn't understand. Now, while this isn't exactly a common occurrence for most advisors, it is still nonetheless a risk that prospective advisors have to consider when making a career decision. That said, as I mentioned earlier, The earnings potential for wealth management advisors is generally much higher than for financial planners, and it's uncapped. Advisors who successfully build a large book of business can earn just as much as a senior investment banker and fund managers without the long hours or extreme stress. This is also the only type of role in the banking industry, very unique, where an individual can truly own their own book of business and then sell that book of business as part of a retirement plan. And this is something we're going to touch on a bit later. Now, as someone considering a career in this space, you'll need to weigh out the pros and cons of all of these types of risks, as well as the skills that are required and what you most naturally are good at to determine which career path is going to be the best for you. All right, so we've discussed the three key types of advisors: financial planners, investment advisors, and portfolio managers. And we spent a lot of time going through the differences between them, but there's again a lot of similarities between these different types of advisors, and it all starts off with a solid financial plan. Now, no matter who the client is, what level of wealth they possess, and what complexity is involved in their personal or financial situation, their advisor needs to take the time to sit down with them to understand and document their goals and put together a plan to reach them. So, what do all three tiers of advisors, what is a process that they all have in common? That common denominator is the financial planning process. Now, as the financial planning industry has grown and evolved over the past few decades, the methodology used to generate a financial plan has also changed rapidly and for the much better. Whereas in the recent past, a typical financial plan would focus solely on funding a client's retirement, modern financial plans do that and so much more. So currently, the best practice for financial planning processes revolves around a goals-based investment approach rather than an approach that focuses on maximizing return on investment or beating some sort of benchmark. So what do I mean by goals-based investment approach? Well, rather than looking only at a client's retirement objectives, goals-based planning broadens the focus of the plan to take into account all aspects of that client's financial life. So this can include planning to fund pre or post-retirement expenses, either one-off or recurring, such as buying a house or a car, planning for a child's wedding or education, renovating a house, starting a business, building an emergency fund, or lavish vacations. The advisor, usually with the help of one of many off-the-shelf financial planning software packages, will structure the client's investment mix in such a way that minimizes the probability of failing to fund these stated goals. A key skill that successful financial planners and really just generally financial advisors build over time is the ability to obtain as much key information about a client's goals and objectives as possible without coming across as inauthentic or as if they are interrogating the client. Now, naturally, this can make the client feel very uncomfortable, which will lead to them withholding information, and that results in a financial plan that's less than ideal. So for each of the client's goals that are documented in the plan, there's a number of crucial inputs that have to be collected. And these are: what would it cost to reach this goal now? What will it cost to reach this goal in the future? How much time does the client have to save and invest for the goal? How much does the client need to invest to achieve this goal?